My name is Demery Walters. I work with Real Estate Business Analytics. I'm here with Adam Slackman. He's off stage for now, previously of Markerr, but now of REBA, under the REBA umbrella. And I'm here to just nerd out about data with y'all for the next 20 minutes. So I have been working in multifamily for a few years now within data specifically, and I want to start off the presentation with an observation. In my time working in multifamily data, I've noticed that every organization, every leader, and every group that I've worked with and spoken to would classify themselves easily, no question, as data-driven. It's almost not even a question anymore in the industry, right? If you ask if someone's data-driven, it's, oh, well, yes. I mean, of course. Look at our spreadsheets. Look at our data pipelines. Look at our web scrapes. Look at our dashboards. Easily, we're data-driven. And yet, if you ask any one of those groups, leaders, organizations, if they can point to a missed budget assumption that affected their bottom line significantly in the last 12 to 24 months, they'd be able to point to one of those too. That's an interesting gap, right? Because we all have so much data laying around, and yet the ability to actually bridge that into something that meaningfully affects the bottom line and drives your decisions in the correct direction isn't quite landing. I think that's because in multifamily, we've started to mistake having data for having insights. And that's a big gap. Now, I've worked in data in a few different industries, and I have to say of any industry I've worked in, multifamily has got to be the most interesting because more than any industry, we are absolutely drowning in data. Every organization is going to be able to point you to, well, we've got our asset performance reports, got our financial forecasts, got our financial statements, got our market reports, CRM reports, leasing dashboards, CapEx trackers, reputation reporting, underwriting, pricing trends, inspection data, web scrapers, SEO analytics. It goes on and on and on. And every one of them is going to be able to be surrounded by dashboards at any given point and be able to say, of course, I'm going to move in the right direction. I'm surrounded by data. How could I possibly make the wrong choice? That brings me to my thesis for our talk. I think that because we're drowning in data, we've started to see a trend where instead of having data drive us towards better decisions, we're starting to almost see the opposite. That we have so much data around us that it's starting to just make us make more confident bad decisions. So with that, I want to talk through a few specific factions I'm seeing form in the multifamily data space, where I'm seeing our market data fanatics. They're the ones that are going to pull up their market intelligence dashboards because they need to keep an eye on their market occupancy, their job growth, their supply, income trends, population trends. They want to understand every corner of the environment that they're selling to, and they believe that's what's going to project them towards the right decision. On the other side, we're going to have our portfolio data evangelists. They're the ones that want to understand down to the unit level what's going on across the portfolio. They want to know every detail of their leasing funnel. They want to know the renewal reasons behind every renewal. They want to dig into their collections dollar by dollar. They want to understand their financials month over month, pricing trends, LTO. They want to know every square foot of their portfolio because they believe that's going to lead them to the right decision. My argument is that while both of these are well-educated opinions, while both of them have a ton of accurate data that's going to help you in some regard, ultimately, they're both dangerous in a silo. And that without combining these data sets, you're missing out on one of the biggest competitive advantages data can actually give you. First, that's going to be your asset positioning. Knowing what's going on in the environment is great, but without knowing where you fit in that environment, what are your unique strengths, or what are your unique risks that you pose in that market? And second, your contextual performance, right? You might have a property that is killing it in a vacuum, but you don't know without looking at that market data if there are some silent issues that are going to surface before you know it. With that, I want to talk through a few examples, a few very real-world examples of where this siloed thinking can lead us to very real mistakes. I want to start off by looking at what can happen with that market side of things. Now let's imagine you are focused on those market intelligence dashboards. You've been keeping an eye on the Dallas-Fort Worth market, and man, it is not getting better. You've been looking quarter over quarter, year over year, and gosh, if occupancy isn't down another 50 basis points, and multifamily construction, while no longer accelerating, isn't really slowing down either. It's staying pretty steady. For all intents and purposes, it would be very easy to look at this and say, man, our demand signals are weakening. And if you start doing some Googling, your headlines are likely to agree. Now, I do want to reiterate, this is not an uneducated opinion. This is actually data-backed. It's a data-driven opinion and can easily lead you to a data-driven decision. Let's enter defense mode, right? If this is where we're headed, if demand's going to weaken, we might need to cut some expenses. We might want to divert some marketing spend. We might want to cut down on our hiring. We might even adjust our pricing strategy to try to get ahead of it. But here's what you could be missing. If you're just looking at that market data and you haven't looked into your portfolio data, you could miss something like this. The top left chart here, well, strange. Looks like in Dallas, our traffic is pretty consistent. Our conversions, pretty consistent. But when we look at our occupancy and renewals, we see a downtrend, but if you look at that unit type, it's really specific and concentrated on our larger units. Now, of course, that's a much different conclusion, right? It's not that demand is entirely dropping off in Dallas. It's that we have a concentrated and specific area where demand is shifting. So that's going to lead to different conclusions, right? Where you might have diverted marketing spend, entirely, you now might shift it to those exposed units, right? You might assess your amenity charges. If that's no longer going to be palatable to market for some amount of time, right? You might protect your pricing for your smaller units, maybe adjust pricing strategy only on those exposed units. You might even do something like adjust your CapEx plans, right? If you're not going to see ROI on those high amenity units, because that's not really what's in the taste of the upcoming market, that might be something to adjust. Now, again, I do want to reiterate, this isn't saying market data is bad. It was still an educated decision, but dangerously incomplete. And it's a decision most orgs easily would have made, right? Because they're going to have those members of the organization that are sitting with their market intelligence data in one room. They're going to have their portfolio data in another room, different decision makers, different teams, and they're not really going to be able to reconcile until something's already gone wrong. Now let's look at the other side. I don't want to rag on my market intelligence friends. Let's look at what happens if you forget the market intelligence. Now let's say you've got the opposite going on. Maybe you're an RM and you're keeping an eye on your Florida markets, and man, if Tampa just isn't keeping it consistent. Occupancy looks great, renewals look great, collections are on track, your NOI versus budget's on track, everything looks fine, right? You got your quarter over quarter NOI, it's above budget in most quarters, a little bit of a dip in Q3, but expenses happen. This is an easy hand wave. I got so much going on, I got other stuff to worry about. I'm gonna move right on. Tampa's not in my concerns. Again, you did your due diligence, you looked at your data, but you could be missing something. And I do want to stress, this is a much, much more dangerous example than the first one. In our first case study, at least there were alarm bells raised, right? The data was telling you something's wrong, go dig in. But when you have a situation like this, you're operating with data in a silo, and all you're being told is, things are great, look away, go look over there. That's where you're going to miss your really big opportunities. If you look at your market data, first thing we're seeing over there is your construction and your occupancy. Now, occupancy way zoomed in like that. You can see that axis is between, I think, 92 and 98. You're zoomed in that far, you can see it's starting to trend down a little bit. Over here, it looked green. You were still above your benchmarks. But when you're looking at that occupancy starting to dip and you're seeing that construction's ramping up, and especially when you look at chart number 2 here, and you see that your population, your employee population specifically, is leveling, but construction's still ramping, and you're getting some very early indicators that something could be coming, it's your time now to act, right? Things are going great now. Your NOI for this quarter is not going to be affected by what's coming. But this is the opportunity to start maybe reforecasting, right? To start thinking about what's your renewal strategy going to look like? Because what you're coming up on is some aggressive lease-ups with some great concessions, some great deals. You're going to come up on even single-family opportunities, right? We got LGI Homes out there saying $0 down. You're gonna have a lot to compete against. And right now, you have the opportunity to scope that before those units hit the market. Or you could miss it. So what I want to stress here, again, is that this isn't a data issue. The data is not wrong in either regard, and both of them are super important. What I think multifamily is facing, rather than a data issue, is a reconciliation issue. Because when you have your finance data living over here, your performance data over here, and your market data over here, owned by different departments, different team leads, the best bet you're gonna have at getting them all in one spot, unless you're planning for that, is an analyst with a whole lot of VLOOKUPs and Excel spreadsheets and a whole lot of human error. And by the time that comes around, by the time that data is brought together, it's gonna be old and you might have missed it. The solution is not gonna be more data, and it's not gonna be more analysts, and it's certainly not more spreadsheets. The solution to the problem is making sure you have a single pane of glass that allows you to see that market data, to see that performance data in one view that lets you switch contexts, where you can see what's going on at the market, you can see what's going on in your performance in one screen, one tool, one team. Now with that, I do want to pass it over to Adam to talk about the most important place where you can use that intersection of data. And really that's going to be in your budgeting and forecasting. Adam?
Thanks, Demery. And just further to Demery's point on using market data to help forecast and predict for how to budget in the future. We've worked with a number of different teams across multifamily REBA has acquired Markerr as of December 2025, so just a few months ago. And we leverage quantitative market forecasts versus legacy providers have more research-driven approach, econometric driven forecasts. We leverage a market forecast, and incorporating that into your budgeting process can help give you a better view into the overall prediction of how the portfolio is going to perform in a given year. So in this case, budgeting without a forecast, just looking at trends from prior years and pulling it forward may not always give you the entire story versus walking into budgeting season with a full quantitative forecast. We actually we run a back test and a validation against our forecast each year. And we actually found in a recent portfolio that if the client had chosen the top forecasted zips in a market based on just acquiring a property alone, they would have had 38% higher ROI on the property. So incorporating that data into your budgeting process is a way to help bridge that gap. So we took Austin as an example here. It's actually one of our lowest forecasted markets on a 5-year basis. But you could see the last few years, as I described, taking last year's data and pulling it forward may have served you well since 2024. 2025 and this current year, it's pretty flat in Austin, but we are projecting an increase in the next short term, 2 years out. So knowing that going into your budgeting season, you can prepare to optimize if you have a portfolio within this market. So it's bridging the gap between taking the quantitative ability to look into the future and take that pane of glass and turn it into sort of a crystal ball and bridge that into how you're going to incorporate into your planning for next budgeting season.